In our industry, people often talk about multiples as if there's some sort of fixed magical number, and if every car wash business is worth a certain number based solely on EBITDA or location count. But in reality, the multiple is the output of a much deeper story. More recently, the market has become more selective. Buyers are still in fact active, but they are definitely more disciplined today. Capital is still available, but it's being deployed with much more selectivity and overall a lot more discipline. This isn't just a presentation about selling your business. In many ways, the same things that drive value in a transaction are the same exact things that drive better operating performance every single day. Cleaner financial story, stronger recurring revenue, better site execution, disciplined labor management, higher customer retention, and capable leadership team all create value. My name is Chris Jenks. I'm a partner with Amplify Capital Group, and thank you for joining today for an in-depth episode of Behind the Business. Really excited to spend some time with you today talking about a topic that is highly relevant to owners, operators, investors, lenders, and anyone else who's trying to better understand where the car wash industry is headed. What actually moves valuations in today's M&A market, and what metrics matter most for increasing valuations. So today, the title of this presentation is What Moves the Multiple, Metrics and Trends Driving Car Wash M&A. And that phrase is intentional. In our industry, people often talk about multiples as if there's some sort of fixed magical number, and if every car wash business is worth a certain number based solely on EBITDA or location count. But in reality, the multiple is the output of a much deeper story. It reflects the quality of the business, the durability of the revenue, the strength of the team, the growth runway, the competitive landscape, the conditions of the asset, and the confidence that the buyer has in the performance they are underwriting today will continue and ideally grow over time. So over the last 7 years, the car wash market has gone through a dramatic evolution. We saw a period of rapid consolidation, aggressive capital deployment, elevated valuations, and significant new development within this space. More recently, the market has become more selective. Buyers are still in fact active, but they are definitely more disciplined today. Capital is still available, but it's being deployed with much more selectivity and overall a lot more discipline. And the difference between an average asset and a premium platform has become much more pronounced in today's market. So that is really what today's value discussion is all about here. We're going to look beyond headline multiples and talk about the specific metrics and trends that influence value. Things like membership penetration, churn, revenue per car, labor efficiency, site level margins, market density, all factors relevant today to understanding what's the value of your business. So for owners, my hope today is that the session helps you better understand how buyers think, what they prioritize, and where you may have opportunities to strengthen your respective business before considering a transaction. For investors or lenders in this space, I hope this provides a clear view into how quality is being assessed in the current market. And for operators, whether you're actively thinking about pursuing an M&A or not, these are the same metrics that generally separate stronger businesses from weaker ones. And if you're not currently in the car wash industry and are wondering why you're seeing all these car washes popping up all over your town, this will help you understand why. So one important point I want to make at the onset here is that this isn't just a presentation about selling your business. In many ways, the same things that drive value in a transaction are the same exact things that drive better operating performance every single day. So a cleaner financial story, stronger recurring revenue, better site execution, disciplined labor management, higher customer retention, and capable leadership team all create value. So whether you sell next year, 5 years from now, or never, and you just cash flow your business, highly relevant topic today. So as we go through this, I encourage you to think about your own business or the businesses you work with and ask, where are we strong? Where are we exposed? And what would a sophisticated buyer investor see if they looked under the hood today? So with that, let's go ahead and get started. A little bit of an introduction to Amplify Capital Group. Amplify, we're a boutique M&A and capital advisory firm with deep specialization in the car wash sector. So while we do represent clients across a wide array of different sectors, we do have deep vertical specialization within the car wash space. And we built our firm by combining Wall Street transaction experience with real operator perspective. I myself am an owner-operator of 6 car washes here in the Chicagoland market, and that really helps us understand this space with deep intimacy. So we know how to talk the talk and walk the walk. In our track record, we've closed over $5 billion worth of transactions, specifically in the car wash sector, including several of the most significant deals in the space today over the last 5 years. And what we're going to cover today isn't just academic or theoretical advice. These are metrics, structures, and valuation conversations that we work through in live deals every day. This isn't AI driven, right? This is real practical insights. And our experience across the space gives us a real front row view into how buyers are underwriting the sector today. So most of what we'll cover, again, not theory. These are numbers, questions, and deal structures that we negotiate every day on behalf of the owners and operators that we have the pleasure of representing. So a little bit of what we do. We do support clients across the full continuum of solutions. That includes sell side, buy side, capital raising, partnerships, operations advisory, venture capital, and brokerage. And in car wash, that matters a lot because value creation doesn't just happen at the point of sale or transaction. It is long before that. So full exit is really just one of many options. We could help assist our relationships, our clients with recapping their business, whether it be reforming their debt for growth or bringing in some minority equity, participating in joint ventures, selective monetizations, which is increasingly relevant in today's world, as well as the need for liquidity is very real. But the best outcomes usually happen when financial strategy and operational performance and real estate strategy are all aligned. So we are often known as just the deal people in car washing, but the reality is we do a lot more than that. We've helped incubate some of the most innovative solutions in the car wash space today with our partnership, the like of AMP memberships, Retention Express. And the reason why I want to highlight this is this gives us a real full 360 view of the car wash sector beyond just the transactional side of the business. So first, level set today. So before we start jumping into the metrics that do matter, I really want to level set on where the market is today, where we've been, and cover kind of where multiples are, who the active buyers are, and what's really driving deal flow. All right, so looking at some notable transactions as of late here across the car wash sector going back to 2021. And really, the logos matter less on this page than more of the shape of the volume. And what we saw in 2021 and 2022 were record years for car wash consolidation. 2021, we saw approximately 63 transactions representing 391 car wash sites in terms of transactional volume for the year. And as you look ahead to 2022, you see that number balloon. 102 transactions across 521 units. And this is really the pinnacle of car wash consolidation. What you saw then in 2023, 2024, all the way through the first half of 2025 was almost a reset and a pause of car wash consolidation. And a large reason for this was really kind of the cost of capital environment, right? 2022 going to 2023, we saw the Federal Reserve start to tighten by way of increasing interest rates to combat rapid inflation. And as a result of that, just coupled with the sheer volume of new units coming online, as well as some stress in the marketplace with the likes of Driven Brands divesting their Take 5 car wash portfolio and ultimately Zips emerging from Chapter 11, we saw a significant reset and a pause in car wash consolidation. And a lot of platforms and sponsor-backed groups redirected their focus from growing unit count to operational excellence. And as we look in 2025, in the second half of the year in particular, we saw a reemergence of car wash consolidation, largely fueled by the restoration of bonus depreciation by way of the One Big Beautiful Bill Act. So looking back last year, 2025, we saw a pickup, 51 transactions across 663 sites. And as you look over to the right-hand side of the page here, you see a big driver of that was Whistle Express, formerly known as Magnolia, acquiring the Take 5 stores from Driven Brands, 383 units. So a significant portion of those 683 sites trading hands last year were largely attributed to the Whistle acquisition of the Take 5 stores. Now, as we flash forward to 2026 here, you may note at the top of the page here, proud to announce a recent transaction here that Amplify was a participant in, representing Canton Car Wash through the acquisition by L Car Wash. And this really marked, an expansion and entrance into a new market for L. And I think it's just the ultimate proof statement that high quality transactions are still getting done in today's world. But the key takeaway here is that discipline is back. So it's not competition for assets just for the sake of building unit count. It's competition for quality assets. And that's precisely what we saw here with the L Car Wash acquisition of Canton Car Wash in the Baltimore market here. Good businesses are still getting strong attention. but just the market is a lot more selective today than they have been historically. All right, looking at multiples over time. And one of the clearest valuation patterns as we look across this board here kind of coincides with that previous page as we saw kind of that increase in deal activity over 2022. This was definitely the peak of multiples here. So we're looking at this page as we're breaking out average multiples for 4 sites or fewer versus greater than 4 sites. We're going back to 2020. And we'll see here, smaller chains represented by 4 sites or fewer. These are typically what we'd consider bolt-on acquisitions, have averaged around 10.5x EBITDA. Portfolios with more than 4 sites have averaged roughly 13.2 times EBITDA. And again, as mentioned here, as you look at 2022, we saw this is really kind of the height of valuation multiples with average transaction representing 4 units or more hitting roughly 17.5 times EBITDA. And we've seen valuation multiples have moderated quite a bit from this peak here. And, really want to highlight here, I think a lot of groups, have in their mind, hey, I'll wait to sell or entertain selling my business once multiples recover to those 2022 levels. Well, you may be waiting for a while here. Something we often talk about in the marketplace is, the reality is 2022 is really the exception to the norm. If you look at that long-term average, again, 4 sites or more hovering around 13 times EBITDA. And if you look at where we've been the last 3 years, we're back to where normal has been historically. So a little caveat there, if you're expecting multiples to recover to those 2022 levels, that may not happen. But nonetheless, as we look at kind of the spread between sub 5 sites versus 4 sites or more, there's a pretty consistent spread of about 250 to 300 basis points in a premium. And that premium just isn't simply about size. It reflects what scale enables, right? Which is denser operations, stronger management infrastructure, better customer acquisition strategy, and just overall more strategic relevance to buyers. So in other words, scale is valuable when it produces better, more defendable economics, and it's not just necessarily a free lunch for being large. So you see that pretty pervasive spread across time here. But the reality is here, we get asked this question all the time. We're at valuation multiples today. And, I think what a lot of groups will tell you may be a little bit misleading, right? Because the reality is no 2 businesses are valued the same way. So a big part of the focus for the remainder of our conversation as we move on here today are what metrics matter and how do you command a premium multiple in today's marketplace? Before I wrap up on this slide here, the last point I want to make here is 2026, the comp set that we're using here. This would include both completed deals as well as deals that we have visibility into that are currently under exclusivity, so have yet to close. And, the one thing I do want to highlight here is that, we are seeing a lot more asset-light transactions in which the real estate would not be included as a part of the deal. So we are seeing a little bit of a shift where historically, a lot of the multiples that we're using are EBITDA-based multiples, where we are seeing a greater composition in our data set of EBITDA, meaning that the real estate is not included. And I do want to highlight that because that's one very important caveat because you generally see, about 2 to 3 turns in a premium on multiples for EBITDA versus EBITDA in which the real estate is included as a part of the transaction. But again, don't want to focus too much time here over where multiples are at today, because again, there are a lot of groups out there that, in our opinion, are spreading a lot of falsehoods in terms of how businesses may be valued. And what we want to do today is provide that depth and really separate kind of where the market is versus how buyers think about your business and what that means in terms of extrapolating greater value. All right, moving on and looking at kind of a snapshot of the largest operators in the U.S. The top 10 operators have grown dramatically since 2021. If you look at the top 10 collectively, they've expanded by more than 125% over the last 5 years. And what this tells you is that consolidation has not paused. It has continued, albeit unevenly. Right? If you were to look at kind of the growth going in from 2022 to 2023, 2022, 40% growth, saw a pretty big pause in 2023, as we've previously mentioned, about 10% growth, and the top 10 adding an incremental 194 units. But again, as we look forward to 2025, saw a pretty big pickup in activity, 519 new incremental units. Collectively, 2021 through 2025, again, as mentioned, the top 10 operators and platforms have added over 1,700 units to their unit count. Conversely, looking from 24 to 25 here, 519 incremental units. So again, some pretty interesting consolidation here on the board. Mr. Car Wash reestablishing themselves as the largest car wash operator in the country. Big news around Mr. Car Wash in 2026, going from public markets to private. 2025, they're currently hovering just north of 500 units. You see Whistle Express about 477 units. Some rapid expansion there over the last 5 years, growing north of 900%. Again, with the acquisition of the Take 5 stores in 2025. The Wildcat platform, which is a multi-brand unit, Club Car Wash being one of the quickest growing brands underneath the Wildcat platform, currently today at 385 units. Quick Quack, we saw a pretty rapid acceleration of growth as they brought in some sponsor capital with KKR. Tommy's the franchise model, but nonetheless here again, top 10 experiencing some pretty significant growth here as we look back to 2021 through unit counts, most current in 2025. All right, looking at other notable operators here, this would really represent that, the next 10. And I really think, in my opinion, this group is equally important because this is where some of the most interesting sponsor-backed and regional growth stories are happening today. And what you'll see here is that gap between the largest players and the next tier has narrowed significantly. All right, as we look at the pace of growth here within this subset of operators and platforms, you see last year, 2025, 695 incremental units added. And going back from 2021 to 2025, this cohort specifically has grown by 131%, adding 2,247 units to their platform counts. So again, this is a really important reminder that the buyer universe today is not limited to only the very biggest names within this sector. A lot of the strategic value sits in these emerging platforms that are building density, improving their brand awareness, and preparing for that next stage of consolidation here. So just to recap again, who's growing most aggressively in this space? You really see 6 sponsor-backed platforms that accounted for a majority of the net unit additions in 2025. This is important because it shows that private equity and institutional capital in general is still very active in the car wash sector. So sponsors are definitely not just sitting on the sidelines. They're deploying capital and by and large represent the fastest growing operator pool. And that's all largely sponsor backed. So the real key takeaway here is that institutional capital still likes this space, especially when it sees runway, fragmentation, and recurring revenues, which is something that is very, very evident within the car wash sector today. All right, so now this next section is really the heart of the presentation here. We're going to move from market context in terms of who's growing where and the history of consolidation in the car wash sector to really the operational and financial drivers that separate market valuations from premium valuations. All right, so every transaction, whether it's 4 locations or 40 locations, ultimately comes down to this equation. Enterprise value equals EBITDA or EBITDAR times the EBITDA or EBITDAR multiple. And I will tell you, most operators obsessed over the left-hand side of this slide, which is EBITDA. But the multiple is often where the biggest value creation opportunity lies. You can't control where the market multiple is, but you can absolutely control how you position your business for premium multiples based on the KPIs and metrics that matter most for the buyer pool. So we take a business out to market. Say we have illustratively 2 operators, both the same EBITDA profile at roughly $10 million in EBITDA. One trades at 9x, one trades at 12x. They're same industry, same market. So this is why premium multiples are usually earned operationally, not just negotiated financially. What we want to do today is understand what drives the difference between the multiple. So really, as we look at the impacts of what drives a multiple, the difference really boils down to these 3 points here on the page. When buyers underwrite a transaction, they really ask themselves 3 questions. How durable are the earnings? How scalable is the platform? How much growth is left? And how risky is the cash flow that I'm underwriting to? And buyers underwrite every deal through these 3 lenses. It's all about earnings quality, growth potential, and the risk profile of the acquisition. So first, as we assess earning qualities, it's really understanding kind of how durable are the earnings themselves. And some of the metrics that really matter most here would include recurring revenue as an overall percentage of the transactional mix. We call that membership penetration. We'll talk more about that here in a moment. You really want to understand margin durability, concentration risk of revenues, as well as just the overall, in general, quality of the financials that they're underwriting to themselves. And this is usually teased out through the quality of earnings process. Second, buyers always ask how much runway is left and how scalable is this platform? So really looking at ramp profiles of new stores, understanding same-store sales trajectory, the pipeline, white space in the local market, the brand strength in market, the ability to drive higher revenue per car by way of optimizing pricing, or just the overall scalability of the operational infrastructure for the acquisition. Third is how much risk sits underneath the cash flow. And I will tell you right now, private equity hates underwriting to risk. So some considerations here are, lease versus own real estate mix. Owning that real estate certainly offers a very attractive backstops to mitigating risk for acquirers. That said, it's not to say that they will only buy car washes with owned real estate in certain geographies that offer tremendous density, as well as, entitlements tough that may be landlocked. Leased opportunities are certainly abundant, but nonetheless, owning real estate certainly helps lower that risk profile. Maintenance and CapEx outlook, I will tell you, as we've seen that reset in that 2023 through 2024 timeframe, a lot of groups today are certainly a lot more sensitive and aware to deferred maintenance. So they understand if they acquire that unit, what it's going to take in terms of additional CapEx spend to meet the operational standards of that acquiring platform. So really understand maintenance and CapEx outlook. Management depth beyond the founder is definitely a key consideration here, as well as just the overall potential for encroachment. Again, I talked about white space being consideration, the growth potential of the platform. It's certainly a consideration here too as it relates to the risk profile of the acquisition. We have seen tremendous amounts of encroachment in certain markets. So definitely a heightened sensitivity today to the white space within that particular MSA. As we think about risk here, this is really an all-encompassing equation, right? Multiples in general compress when there's more uncertainty. Multiples expand when you have greater predictability, scalability, and professionalism, right? So what we really want to do here now is pivot to the rest of this section, which is about the metrics that help to answer these three questions here, which are, what are the quality of earnings, what's the growth potential, and what's the risk profile of this acquisition? So first, I want to start with membership penetration. As we talk about earnings quality, a big reason why there's so much interest in this sector is the recurring revenue model by way of the unlimited subscriptions. And the best way to talk about how much of the revenue is derived from the subscription model is by talking about membership penetration. So what is membership penetration? What does it capture? Membership penetration overall is just simply the percentage of revenues or wash volumes that come from your unlimited subscription members versus your single wash retail customers. And it helps to capture the strength and adoption of your unlimited program, the stability and the predictability of your revenue base, the degree of customer loyalty and retention, and the overall resilience of your business against weather or other traffic swings. No surprise to anybody here, if you're in this sector, it's an incredibly cyclical business. Having the backstop of a strong membership program provides a tremendous amount of certainty in your financial performance. And it's really, the heartbeat of your recurring revenue model, right? The higher the membership penetration rates, the steadier cash flows, the stronger customer loyalty, and ultimately the higher your enterprise value. Because as we talked about in the previous slide, predictability reduces risk. Lower risk results in a premium multiple. So you, in general, will receive a higher valuation for your subscription revenue. And as we talk about kind of what sits in best of class, some of the best in class operators within this sector will have membership penetration rates in that 65 to 80% range. So again, 65 to 80% of revenues being derived from their subscription program. And this would represent a mature, well-managed membership program. Conversely, if we see groups with less than 30% in membership penetration rates, this would suggest that there's heavy retail dependence, which will ultimately result in inconsistent sales and performance and overall greater exposure to cyclicality in your business, whether it be just the normal seasonal element to the business or unpredictable weather impacts. So again, membership penetration here really captures the lifeblood of this business, which is the membership model and the degree of revenue that you have that could be derived from the membership program you implement. Continuing down, talking about memberships, really want to talk a lot here about membership conversions and churn. Right? Because these are really the two flywheel metrics of your subscription model. Conversions tell you how effectively you're adding members, while churn tells you whether the bucket is leaking faster than you're filling it. Okay, so a healthy chain converts consistently and retains efficiently. So as we think about conversion, that number tells you how effectively you turn your prospects and retail customers into a paying recurring subscription member. Conversely, as we talk about churn, this is measured on a monthly basis. This is the percentage of members that cancel or stop paying for their subscription every month. Okay. So again, a healthy car wash chain maintains steady new member conversions and a low churn, which means high retention of your membership base. That combination in itself leads to predictable compounding membership revenue, which is the foundation of valuation growth. So really the most successful operators don't just focus on signing up new members, they focus also on keeping them, because every retained member adds months and dollars to lifetime value, which we'll talk about here in a moment. And as we talked about, again, buyers underwrite to risk, in which membership retention is a critical factor. So talk about what good looks like in this business. Some of the best operators, I think an ideal zone to land in would convert 10% to 20% of retail customers as subscription members. So in other words, if you have 100 retail customers, you have about 10 to 20 customers signing up as an unlimited subscription member. I'll tell you, some of the best operators in the country, they certainly hold a higher standard for their operation, and they try to incentivize their teams to hit 20% or more. But really some important levers to pull on here to help improve your conversion rates. Really it all starts with that frontline engagement at the point of sale, ensuring that you have a well-trained staff that could properly and efficiently articulate the benefits of a subscription plan and why it's so important for that customer to consider, not paying for a single high price ticket, but instead pay one flat monthly rate for unlimited car washes. Pricing and promotional strategy is certainly a significant lever to pull here as you think about enhancing your conversions, customer experience, throughput, employee incentive structures, and just overall data and KPI tracking, all very valuable levers to pull here as an operator to help improve your conversion. Churn, on the other hand, again, churn is the hole in the bucket, measures how fast you're losing your members. An ideal range, churn should be around 7.5% or lower. If you're north of 7.5%, that usually suggests you have a little bit of a problem. If you're lower, that would say you're doing a really nice job delivering exceptional customer experience, and your customers and your members in general see the benefit of their subscription plan. But what's really important here is taking that next cut of understanding the drivers of churn here. And you can break churn out into two separate buckets. You have voluntary churn, which is, hey, I'm moving, or I'm not using my subscription, or I'm just not happy with the wash quality or customer experience I'm getting. That would be considered voluntary churn. And in general, this should represent approximately 2/3 of your aggregate churn. So again, if you're hitting that ideal level of 7.5%, about 5% would be voluntary. On the other side of that, you have involuntary churn. So people may ask, what would that be? These would be customers that end up canceling due to failure to recharge. And this could be, declined credit cards. This could be, expired cards, new cards, people just not having the balance in their bank accounts if they're putting, debit cards on file. But really, failed payments in general, that's, in my opinion, one of the cheapest fix. And there's a tremendous amount of insights that could be derived from monitoring involuntary churn. I'm telling you today, as an operator, in light of, environment where we're starting to see 90-day default rates on credit cards and car loans pick up, to me, it's the ultimate canary in the coal mine to assess if whether or not there's economic stress in the horizon. And more importantly, making sure that our teams are trained up of having solid retention strategies in play. So the reason why I highlight this is, it's important to understand churn, making sure that the churn of your membership base is within a healthy level, but it's also really important to understand the drivers of churn and putting together strategies and programs that can help combat, because again, the best operators just don't focus on conversions. They focus on conversions in conjunction with membership retention.
Stay tuned for part 2 airing next week, where the discussion continues on another exciting episode of Behind the Business. Till next time.